All right, futures turning lower. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Wow. Brent spiking to over $108 a barrel as a strike on Iran's South Pars gas field escalates tensions.
And that happens on Fed Day. It's decision day at the Federal Reserve. Chair Powell may shed light on how the Iran war is reshaping the economic outlook.
Plus, PIMCO, 6th Street, and Bill Dudley join the chorus of warnings or calming messages on private credit. PIMCO President Christian Straka joins us this hour.
I'm not so sure Christian is going to calm us. He's been warning about bad underwriting.
No, but Dudley was like, it's
okay,
cool.
Yes,
this is not
true.
2008.
Okay, fair
enough.
And
I was there.
He was indeed there. So many worries for the market to be focused on, but maybe retail isn't one of them. I want to show you what Macy's is doing pre-market. Okay, not the biggest company, but it is a recognized name brand. Shares are up 7% in the pre-market, a better than feared outlook for sales and profit. And there was a lot of fear due to the uncertain impact of the Iran war and tariffs will have on spending. Plus, we heard from all the airlines earlier this week, too. Everyone's still buying airfare tickets, too. So it doesn't seem to be much problem for the consumer, at least yet.
Right. The consumer seems okay, although PPI was hot.
Yes, true.
And that could feed into even hotter CPI. Comments from NVIDIA CEO Jensen Huang comparing chatbot OpenClaw to OpenAI. We are looking at tech shares higher after that. Those related to OpenClaw, NVIDIA, you can see not moving itself. Separately, Alibaba and Baidu raised prices by as much as 30% for their AI products. So looking for that ROI, Danny.
Matt, I want to get back to what you mentioned with PPI data coming in. Prices paid to U.S. producers rising in February by double the amount estimated. Stocks fell on the news, but they also fell as developments in the Middle East and Iran warned of more attacks. Let's discuss the economic picture. Bloomberg International economics and policy correspondent Michael McKee, who's in Washington for the Federal Reserve's decision. Mike, what did the data look like?
Data are ugly, Danny. A 0.7% rise month over month in the producer price index for February puts the year over year number at 3.4%, up from 2.9%. The core, and there's two different cores with PPI, but we do the X-Trade one because of the way this is put together, up 0.4% in January, now up 0.5%, 3.5% rate on a year over year basis. And this tells the Fed that there's still inflation pressure out there, particularly since goods prices went up 1.1%. Maybe that's tariffs, but service prices were up 0.5%. And these are February numbers. This is all before the war. And you have to ask today, if the Fed were meeting and there were no war, what would they be doing? What would they be talking about? Because the Fed looks at the PCE index, which is influenced by data that comes in from the PPI and from the CPI, both of which have been hot. And look at that blue line there. That is the PCE index that is the PPI index. The yellow line is the PCE, and it's been following the PPI higher. That is probably going to come in significantly higher, and the Fed is going to be in a position where it really can't say that it wants to cut interest rates. So when we look today at the dot plot, which is really the only new news we'll get since the Fed's not going to raise or lower rates today, are they still pricing in any rate cuts this year? That's going to get a lot of interest. You can see there that they were, as of their last forecast in December, they were penciling in 1 for the year. And now, after the news from Iran and the news with the PPI, traders have priced out any for the year. So where's the Fed on this? 2 o'clock this afternoon.
Yeah, we'll be looking forward to that. You know, Priya Misra was on with you, on Bloomberg Surveillance with you earlier, Mike, and she said what she's looking for from the Fed is how they view higher oil prices and higher gas prices, working their way into core inflation, because, of course, the core doesn't include fuel or food prices. But what are those knock-on effects? What are those second-round effects?
The second-round effects are that there are fuel price pressures in all kinds of products, because basically any truck that moves this stuff or train has to use fuel to get there. So that increases prices. Plus, petroleum's used in plastics. Petroleum's used in pharmaceuticals. It's all over the place. It takes a while to work through that chain, but it does get into the into the prices of many goods in the United States and even services. It'll be something that the Fed is going to be watching at this point because they have no idea how long all this is going to last. Their instinct, look through this, but if prices stay elevated for quite some time, then it does have second-round effects they may have to deal with.
All right, Mike McKee, Bloomberg's international policy and economics correspondent in Washington for the Fed meeting today. Don't miss our special coverage of the Fed decision that kicks off at 1:30 p.m. New York time with a special edition of Bloomberg Surveillance. Now, Brent crude, as we just saw, topping $108 a barrel after Iran said U.S. and Israeli airstrikes hit its giant South Pars gas field, escalating attacks on critical energy assets. Meanwhile, Tehran is showing no sign of backing down, vowing revenge for the killing of its security chief, or chiefs, maybe I should say plural. President Trump spoke yesterday.
We're not ready to leave yet, but we'll be leaving in the near future. We'll be leaving in pretty much the very near future. But right now they've been decimated from every standpoint. And again, we've had great support from countries in the Middle East, great support, but we've had no support from essentially no support from NATO.
Joining us now is Bloomberg Washington correspondent Tyler Kendall at the White House. And I think the president made 2 points there that we should discuss. One, no help from NATO, which he continues to press on that issue. The other is that we're going to leave very shortly, he said. What do you hear, Tyler, that the president and his colleagues want to see in Iran before they can leave? What do they need to see before they can say, mission accomplished?
Well, Matt, that's perhaps the biggest question, and why President Trump is repeatedly asked about his objectives and how the White House is ultimately measuring progress when it comes to the conflict in the Middle East. And as President Trump mentioned yesterday, confirming that the U.S. has already hit more than 7,000 Iranian military targets. Then the question becomes, what is going to happen next, as a senior Israeli defense official confirms to Bloomberg News that Israel did carry out the strike on Iran's largest natural gas field, marking the first time that the country's upstream oil and gas facilities have been hit during this war. Now, President Trump has said, as you are mentioning, that we could see an end to the war in the, quote, very near future, but that he's not quite ready to let the operations end just yet. He's talked about this idea that we could see the U.S. escalate its own targets when it comes to energy infrastructure in the region. As we report on this latest strike by Israel today, President Trump yesterday reiterated that the U.S. could go after oil depots on Karg Island, something that was a major oil export hub that was hit last Friday by the U.S., but really maintained that the U.S. went after military targets but left that energy infrastructure largely intact. This would be a major escalation. If you look at the data, just for context here, Karg Island exports nearly 9 out of every 10 barrels of Iranian crude, but the latest imagery analyzed by Bloomberg News shows that for the most part, those loadings have continued basically undisrupted. So it really appears that the Strait of Hormuz and getting that reopened has been the main focus of this White House recently. And as we get more and more threats that we could see energy infrastructure targeted, Matt and Danny, as you heard from the president there, he has been really criticizing our NATO allies, but it of course goes beyond NATO allies. Tomorrow we're going to have the Japanese Prime Minister Takaichi here at the White House. And I can say that I just caught up with the U.S. Trade Representative Jamieson Greer within the last hour, who told me that trade negotiators made it very clear to China during trade talks earlier this week that it is in Beijing's best interest to get the Strait of Hormuz opened as quickly as possible.
It does seem insane, doesn't it, that we have hit over 7,000 targets, and yet we continue to allow them to load oil on cargo tankers that are raising resources, that are raising revenue for their retaliation.
Well, we had spoken with someone, I believe it was Ed Morris, this idea, Tyler, that you don't want to destroy the energy infrastructure in Iran, because if there is a regime change, you need some way for Iran to have an economy that's supported. You want oil to still be able to flow out of there if it does become a Venezuela where you have better relationships. But in the meantime, Tyler, you mentioned this, Donald Trump saying that we don't need allies today in a Truth Social saying U.S. allies need to get a grip, step up, and help open the Strait of Hormuz. Is there any likelihood at all that that could happen?
Well, at this point, Danny, yesterday, President Trump, I think it's fair to say, sidestepped a question when asked directly which countries the U.S. is still in active talks with to reopen the Strait of Hormuz. And instead, he decided to tout bilateral relations between the U.S. and countries in the Middle East. But this has really been putting perhaps a finer point on what has long been strained relations between the U.S. and traditional allies when it comes to defense spending, as our own analysts at Bloomberg Economics say that our European allies in particular are constrained by capabilities and politics, but also this concern that the White House could disengage when it comes to the war in Ukraine if they don't step up when it comes to the war in Iran. And I just bring that up because yesterday, President Trump, unprompted multiple times, brought up the war in Ukraine, saying that the U.S. has helped in Ukraine, but our allies aren't helping when it comes to Iran. So that's another thread just to follow here. But you're exactly right. At this point, the president had indicated earlier this week that Secretary of State Marco Rubio could be putting out a coalition, but at this point we've heard from many allies that they're ultimately wary, including the French President Macron yesterday, who says there needs to be calmer situation in order for France to deploy assets to the strait.
Tyler, thank you very much. That's Bloomberg's Tyler Kendall at the White House, and you can find continuing coverage on the war in Iran. T-Live Go is where you want to head on your terminal with all the latest headlines that we will also continue to bring you on this show. Now to AI, where shares of Asian tech companies popped after NVIDIA's Jensen Huang said the platform OpenClaw is the next ChatGPT. Huang also said that he's preparing for more business in China.
We've been licensed for many customers in China for H200. We have received purchase orders from many customers, and we're in the process of restarting our manufacturing.
Let's discuss with Bloomberg Tech Europe anchor Tom McKenzie. Tom, it feels to be the irony of these events for NVIDIA. It doesn't move NVIDIA shares, but it sure moves a whole heck of a lot of other companies. What did we hear from Jensen Huang?
Yeah, we saw the ripple effects, to your point, Danny, across Asia. South Korea, you saw the hardware names. You saw the likes of SK Hynix and Samsung putting in days where they saw gains of, 7-8% across the Kospi. That closed higher. That index by about 5%. That is on expectation that you will need more memory chips. Once again, HBM, high bandwidth memory, to go in to these platforms that are being offered by NVIDIA to power the kind of developments we're seeing in terms of large language models. And in China, OpenClaw. So on China, very, very strong session, particularly for those AI names, because there is this massive rush for these OpenClaw or AI agents that some of the startups there are producing and some of the legacy names like Baidu and Tencent and Alibaba. To continue to do that, they're going to need access to those chips. So it's a bit of a sweet spot now for Jensen Huang. He says he does have those licenses. Reuters reporting that the Chinese government has signed off on multiple Chinese companies being allowed to buy those H200 AI accelerators that, of course, NVIDIA has designed specifically for the Chinese market, that up until this point, NVIDIA has not included in its revenue streams. Jensen Huang saying they are now starting the manufacturing of those H200s for the Chinese market, so potentially opening up another significant revenue stream for NVIDIA at a time where you're seeing just this massive demand for those AI agents as literally queues of people line up outside tech companies in places like Shenzhen, in Beijing and Shanghai to have techies download these OpenClaw agents onto their phones and tablets.
All right. T-Mac, thanks very much for your reporting. Bloomberg Tech Europe anchor Tom McKenzie. By the way, the next episode of Bloomberg Tech Europe, which Tom anchors, will take a deep dive into the chip maker ARM, and catch that episode on April 10th. Here on Bloomberg TV. You can also watch it on the terminal and YouTube.com, as well as our video hub at Bloomberg.com/video. I'm trying to think. ARM, chip maker or designer?
Designer.
They design the chips, right?
Yeah.
They don't actually make them.
Yeah. The one that the UK is very proud of because it was created there in Cambridge and then decided not to list in London.
Yeah, ARM Holdings. Not a chip maker, but an illustrator of sort. Coming up, Disney's Bob Iger is leaving after 2 decades leading the firm. We'll look at the challenges for incoming CEO Josh D'Amaro next. This is Bloomberg Open Interest. Take a look at the intraday trading chart of Brent crude, the global benchmark. It just continues to climb higher and higher. This leg higher here on news that the U.S. has attacked the U.S. and Israel together have attacked a big gas field in Iran. And then Iran says now everything's on the table. They will start to attack the energy infrastructure, or they feel that they are allowed to, of Gulf neighbors. So keep watching this space. 108.50 is the level on crude. Let's get now to high interest. Look at what else is making headlines around the world. Japan's Prime Minister Sanae Takaichi is heading to Washington, D.C. to meet with President Trump tomorrow, but she warns the meeting will be, quote, extremely difficult after rejecting his demand for warships in the Strait of Hormuz. Because Japan's laws prevent sending warships, she's expected to offer logistics support instead. Obviously, Japan uses that oil as well. Oaktree founder Howard Marks is warning that AI's power is making markets harder to predict. He spoke with Bloomberg's Lisa Abramowitz at the Capital Markets Industry Conference.
Well, I think most people are underestimating the impact of AI. Roughly 18 days ago, on a Friday, that a company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
Now, Disney's annual shareholder meeting today marks a formal passing of the baton as Parks chief Josh D'Amaro takes over as CEO from Bob Iger in his second term. The shift signals a future built on experiences and immersive tech, but with weak park outlooks, rising sports costs, and streaming pressures, D'Amaro must restore investor confidence. Danny?
And let's discuss that in the coming AGM with Bloomberg Tech co-host Caroline Hyde. Caroline, what sort of view are we expected to get into the new CEO?
Well, we need some sort of view because he actually hasn't spoken to the press that often. Of course, he's done deep dives with ABC, which of course is part of the overall Disney mega business model. But we want to understand the context in which AI, AR, VR is going to be a technology he leans into. How is he going to really drive what it's analysts are clamoring for, some sort of return to double-digit revenue growth powered by streaming in particular? What is it that he can ask, therefore, of Dana Waldron, who's going to be heading up? Remember, she's the first ever chief creative officer. She's president. She's overseeing the streaming, the movies, basically that sort of side of IP. How are they going to ensure that streaming manages to tackle another juggernaut in the space when we're now seeing that, indeed, we have got that deal between Paramount and Warner Brothers, so HBO Max kind of teaming up with Paramount? What does that mean in terms of the 200 million subscribers they have, basically equivalent to Disney Plus? So how are they going to fend off that challenge? And how is he going to steer, of course, the in real life versions of us going to parks, us getting on all the new boats that they're getting, the new ships that are costing, it's a huge $60 billion investment plan. He's got his team in place, but Josh D'Amaro needs to tell us really what the IP is that he's going to lean on in the future.
You know, I just spent a week at Disney parks and then on a Disney cruise. And cheap. I came away thinking a little bit poorer for it, but thinking the economy is firing on all cylinders. It was packed. They were selling a lot of stuff, and I feel like Disney owns everything. But I don't understand why they can't cash in on ESPN and sports. I mean, that seems to be a nut that media just can't crack, right? Because nobody wants cable TV bills. Everybody's streaming everything, but you still can't see it all in one place. Like, why can't they make money, much more money on this?
I mean, analysts are exactly to your point, being like, where does this fit? Rich Greenfield's been saying maybe you need to sell off ESPN and ABC because it seems to be a bit of a distraction, particularly when that distraction is really expensive. Just think of all the juggernauts who've come into play and want the latest rights to the latest, greatest sporting endeavors. Well, when you're up against Apple and Amazon, well, no wonder all the coffers are getting a little bit more expensive to dig in. So I think people are wondering, what is the ESPN focus? How are they going to think about just serving us and our clients? How are they going to charge us more for it as well? And I think all of this needs to come together. They need more of a visual aid as to how all of these different parts of the business work as one. What about Fortnite? What about Epic Games as well? That was the big risk. And I think this is what Josh D'Amaro is trying to lean into. This is a new era under him versus what he was inherited under Bob Iger. Now, remember, he did 5 years at the helm of all the big parks. He's done 28 years at Disney, but he wants to make out that he's a risk taker, that this is a 100-year-old business that he could push into the next 100 years. What is he going to do? Yes, he went to Abu Dhabi when everyone's currently worrying a little bit more about the Middle East. What are the key risks he going to take? He did the Epic deal. What does Fortnite, what does that IP mean for the future of Disney?
All right, Caroline, thanks very much. Caroline Hyde co-anchors Bloomberg Tech with Ed Ludlow. You can catch that program every day at 11, so just an hour and 40 minutes until it kicks off. Coming up, BNY Wealth's Alicia Levine discusses what's going on right now in terms of stocks, the reaction to oil as Brent crude climbs up over $108 a barrel. And we get a hotter PPI number, much worse inflation than the market had been anticipating. Don't miss Alicia Levine next and the opening bell. This is Bloomberg.
Oil prices spiking this morning. We're now up 4.2% at 107, above $107 a barrel after the Iranians listing the various energy targets that are fair game from now, from Qatar to Saudi Arabia to the UAE. That follows strikes from Israel and the U.S. on more Iranian energy infrastructure. And Matt, add to that hotter PPI. It's not looking like a great day in market so far.
Yeah, certainly not if you're long right now. Less than 4 minutes until the opening bell, and we're looking at futures that have turned lower. They were up for most of the morning, even as Brent was trading at $102 a barrel. Now you see it trading at 108, and as a result, we're looking at a drop in equity index futures. The 10-year yield right now rising to about 422. There's a real concern, or a real tug of war, I should say, between growth concerns and inflation concerns. We got a hotter PPI number out this morning, and I think a tug of war as well between whether or not the U.S. hits energy infrastructure in Iran or protects it, because if we hurt that, we hurt them, but we also drive higher the price of oil. We are back in just 2 minutes' time with the opening bell. BNY Wealth's Alicia Levine joins us as the trading day kicks off. This is Bloomberg Open Interest. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are now down. They had been up most of the morning, and we were looking at potentially another day of gains for stocks. Now futures, at least for now, in the red, 0.4% about on NASDAQ and S&P futures, almost double that on Russell 2000 futures, on concerns about oil and energy infrastructure in the Middle East as this war escalates. Farmer Mac ringing the opening bell at the New York Stock Exchange. A pretty diverse team over there, but look at this diversity, if you can call it that. Not one dude on the stage ringing the bell at the NASDAQ market site. And the cool thing is there is a Red Bull Racing Academy driver here with the chief commercial officer, I believe, of Rocked, and they're celebrating. Hopefully we see an opening up of Formula One. Hopefully we see rule changes, because it's awful to watch.
That is not what they're doing there.
The hybrid aspect is horrendous, and I hope that the women can make it better.
That's obviously not why they're there, Matt. But you know, opinion noted. It's fine. Formula One has been so good this season.
I can't.
The battles, Lewis Hamilton is back in there.
Somebody behind the winning driver all of a sudden has twice as much power, or the guy in front all of a sudden gets cut down to nothing.
Do you hate DRS too? Should they get rid of that?
Yes. Absolutely.
Really?
Just naturally aspirated, big inch motors that wail as fast as they can at every part of the track.
You and I vehemently disagree on this. I couldn't disagree more. Okay, anyway, let me show you what Macy's stock is doing, something completely different. Shares are up 6%. Look, we have fears about oil. Are consumers still going to be able to spend as much? What does geopolitics do to things? It's not having an impact right now. People are still spending, and Macy's had a much better outlook. And we also heard from the airlines earlier this week, Matt. People are spending. Things look okay.
Yeah, it is pretty amazing to see that. I guess we haven't gotten to a point when gas prices are really catching anyone's eye. We're not at $4 as far as national average yet. I did see that California is over $5.50 right now. Here in New York, we're at a measly $3.60. Comments from NVIDIA CEO Jensen Huang comparing chatbot OpenClaw to ChatGPT are sending some tech stocks higher, although NVIDIA itself is down 0.5%. Separately, Alibaba and Baidu are raising prices by as much as 30% for their respective AI products. And so that is driving the ADRs of those two stocks higher. Let's bring in Alicia Levine, head of investment strategy and equities at BNY Wealth. And Alicia, let's talk about the consumer, because as Danny points out, we see stocks like Macy's reacting well. The consumer still spending, isn't yet bothered by gas price increases at the pump.
Look, it's interesting because the consumer sentiment has been wretched for a year, and actually last year, 6 of the 10 worst consumer sentiment numbers actually happened last year while spending was higher. And coming into this, the fear about the war, of course, is gas at the pump and what that's going to do to spending. It just so happens to be hitting right where we have elevated refunds from the IRS. And so you have a support here of sorts over the next few months into the consumer sector coming from the tax code while oil and gas prices are coming higher. So I think everything we heard from the airlines yesterday and from retail today is suggesting that the U.S. economy is coming into this from a position of strength. And if you just look at the asset classes, you know, before the open, the S&P was down 2.4% since the beginning of the war. Tech was actually up slightly. Yields now are up because of the fear about inflation, but gold is down 7% since the beginning of the war. So you have this really weird cross-asset mix of what the assets are telling us about how long this war is going to go on, and for now the consumer is all in.
What do you do, though, when there's just so much volatility? Yes, stocks have been pretty muted, all things considered. I was looking, yesterday was the first day since March 5th that Brent didn't trade above a 5% range. We got it again today with the most recent headlines of Iran targeting more energy facilities. What do you do with that type of market volatility?
Look, I mean, we've expected volatility this year regardless, right? Because, you know, we came into markets, you know, with a high multiple, very high expectations of earnings. Pretty much all strategists out there were very bullish on the year. So that alone tells you you're probably going to have more volatility this year. And we saw it. We had a violently flat market coming into the war where you have massive rotation into down cap, international, emerging markets, and tech actually down and underperforming since November 1st and continuing that. That made for a violently flat market where you had some sectors down 30% and others up 30%. So that is a difficult market. It's difficult for the top line. It is a stock picker's market. But here, I think you just have to watch what the asset classes are telling you. And it's telling you volatility now, stability later, and normalization later. And of course, the big question is, if that is wrong, none of this is being priced into the market. There is some complacency, and you don't really see the left tail risks being priced in yet. And that is the risk here.
Yeah, I mean, look, to that point, we heard indirectly John Zito say he thinks markets should have been down 10%. That was last month. Yesterday, Julian Emanuel said they would have thought 10 to 15, maybe 20% drops. This morning, Peter Cheer was talking about, or Jeff Curry, I should say, from Carlyle on Surveillance, was talking about the fact that oil should be much higher here, and other commodities, it hasn't even been priced into the ags. Where do you see mispricing that investors can take advantage of right now?
So, look, I think all of this is just being priced off the fact that the expectation is that this is over by the end of March or maybe a few weeks later. I think in the beginning it was like, okay, the market can handle 2 weeks of this. And then it was, okay, the market can handle 4 weeks of this. Now we're saying the market can handle 6 weeks of this, if you actually just look at futures pricing on this. To the extent that this keeps on going on, if you have 2-3 months of this, I would suspect that there is definitely mispricing in the equity markets as well as in the oil market as well. Right now, the market is telling you, you know what? We're going to wait and see, because what we know from history is that geopolitical shocks and oil shocks, unless they are systemic and last for a very long time, tend to be priced out of markets within 3 to 6 months. And so with that history, and you can see it, nobody wants to go short. Nobody wants to be underinvested. You have to hedge the volatility. I'd say that's where we are as also. You know, we're students of history here, and the market is telling us it can last for longer. Now, the Xi-Trump meeting was postponed from the end of March. That was like the first focal point of when this might be over. So now it's going to likely go longer. I mean, I think that's what the message of canceling that meeting was.
Is there a scenario, though, where we've realized Iran can control the Strait of Hormuz? They have this ability now. So oil just needs to be reset a little bit higher along the curve further out. Maybe not $100 a barrel, but at least higher than it had been in years past. How does that change your outlook if that's the outcome of this?
So I think you have to ask the question, what's the impact of systemically higher oil prices, right? So we're not going to go back to 65 on Brent and 60 on WTI. What's the impact of that? I think overall, the energy dependence, particularly of the U.S., is much lower than it was, and on the inflation side as well. I think markets can handle it. You're going to get about a 0.1 to 0.2 increase in inflation over, let's say, the forward several years if this is systemically higher. But overall, the fact that there hasn't been a crisis coming out of this, right, either on energy or on asset prices, just telling you the world is less susceptible. Friday at market close, the fear was we were losing 20% of global oil supply because of what was happening in the Strait of Hormuz. So that was 20%, 20 million barrels a day. Turns out by Monday morning, the expectation was we're losing 10%, 10 million barrels a day, because it's made up through other ways, right? So Iran's still selling oil. We had Indian tankers get through. We have 4 to 5 million getting diverted through that Saudi pipeline. All of a sudden, it's not as bad as it looked on Friday. And if you remember the conversation around tariffs, not as bad as it seemed is enough to stabilize markets.
I'm getting a viewer writing in with an interesting point right now. He is saying that the U.S. says when this is over that Iran cannot dictate how long it will last, which goes kind of contrary to what you hear. You know, everybody says it takes two to taco, and we won't have control over when the Strait of Hormuz is open. What do you think about that?
So I think ultimately we have a better environment for supply on the other end of this. I think it's virtually very difficult to say when that is, but you're in a world where you're going to have Venezuela coming back with supply, and you're likely to have whoever, you know, the best outcome is that we can make a deal Venezuela-like with who's ever going to be governing Iran, and you've got just more supply in the world. And that's essentially what you're seeing. You've got backwardation in the oil market. So I heard those Jeff Curry numbers this morning. They were eye-opening. So, but he also said the same thing, that it's in the short-term pricing, right? This is a trader's market on that, not necessarily for the long term.
Even longer term, though, futures are over $70 like a year out, right? So
right, but that's not 108. It's higher than the 65.
Right.
But again, as how that gets priced into inflation, different parts of the world respond differently. Look, yields in global bond markets are much higher than what happened with the U.S. 10-year, because the rest of the world is just much more dependent on what's coming out of the Straits and Brent, obviously, than we are on WTI. It's just a different world. The U.S. is less dependent, and the market is pricing it such.
Alicia, we're going to have to leave it there. Thank you so much for joining us this morning. Always a pleasure to have you on. Alicia Levine, Head of Investment Strategy and Equities at BNY Wealth. A quick check on your equity market. 10 minutes into your trading day, we are moving lower. The futures session at one point was higher, but turned around after a hotter PPI and increased pressure on energy infrastructure in the Middle East. Some of the tech stocks doing well, as you'd expect. Energy is doing well. Exxon, one of the top gainers here, as are defense companies. RTX, that's also one of the best performers. Looking at the downside, it's a lot of safety kind of stocks. The healthcare equity is not doing well. Eli Lilly, AbbVie up there in the top. Some of the consumer staples, Philip Morris, P&G, Coca-Cola. And you'll see that reflected on the GRR screen too. The sectors that aren't doing well are some of the safety ones. This is a phenomenon we've been watching over the past week since the war started. Consumer staples is in the bottom. Healthcare is in the bottom. Materials, maybe that makes more sense as price of commodities go higher. And then you have energy up at the top of the pile. That's clearly a logical one, up 0.4%. For an overall equity market, Matt, that's down about 0.2 here, just moments after the open.
All right, coming up, PIMCO sounds the alarm on the private credit industry. President Christian Straka joins us next to talk about these worries that have been debated hotly for weeks now, even months. This is Bloomberg Open Interest. Time now for our top calls. Some of the analysts' action in focus this morning. First up, Mizuho Securities is downgrading the fertilizer company CF Industries, saying the stock's recent rally from war-related supply fears is overhyped and may not last. The firm says most farmers already bought their fertilizer, so higher prices won't boost sales by as much as expected. Next up, Citi is starting coverage of Netflix again with a buy rating, saying the company will probably raise subscription prices in the U.S. and could also boost its future profit outlook while buying back more of its own stock. And finally, Truist Securities is upgrading Block, saying the company looks more attractive after cutting about 40% of its staff, a move that could boost profits and cash flow. The firm thinks the stock is now cheap compared to similar companies and could return more money to investors. Danny?
Private credit also getting some notable calls, as it has as of late. PIMCO saying that private credit markets are giving investors a reality check as questions arise about whether liquidity and whether risks are properly priced in. Sixth Street says BDCs are facing a reckoning, forcing an industry reset. Park Square Capital founder Robin Dumar told us that he's also concerned about BDCs.
A number of these retail-oriented structures will be frozen. They are not going to be making new investments. They're going to be prioritizing returning capital. What happens in a restructuring? Can you follow your money? Can you draw? Because that's how we protect ourselves ultimately in a restructuring, is to write everything down, follow our money, start over. Can these complexes do that? I think it's going to be more challenging.
Let's add another expert voice to the conversation. Pleased to say that joining us to discuss is PIMCO President Christian Strack. Christian, it's been far too long, my friend. Thank you so much for joining. And I have to say, you've been really far out in front. You've spoken on this program and to us earlier, saying that there are some issues in private credit, that there has been concerns around underwriting and specifically poor underwriting. Now it seems like the rest of the market has come around to your view. Where do we stand? Just how bad and how poor does this asset class look at the moment? So where do we stand now? You've warned about underwriting. How poor does it look?
Sure. So I think what we're starting to see is just a normalization in this space. For far too long, there was lax underwriting standards in direct lending, and with too much leverage put on companies that really didn't need that much leverage on them. What we're seeing is not really a crisis, though. What we're seeing is a cooling in this market, and what we're seeing is a move in default rates from low single digits, call it, it was 1% to 2% a year, moving up to probably 4%, 5%, 6% a year, which brings your returns in this space from what it was as great years of 10, 11, 12%. Returns are going to be in the mid-single digits now. So it's not that necessarily things are hitting a wall and that there's an extreme crisis in direct lending. What there is, though, is a realization that returns are not going to be as perfect as they were for long. Now, of course, there are also the questions around what happens with some of those software exposures in direct lending. What happens with some of the cyclical energy and consumer-related names if we do see a protracted crisis in the Middle East, and a realization there that things have to work really well for direct lending to deliver those high returns that they have over the last several years. And that's what the market is grappling with now.
Well, let's talk about the consequences of that, Christian. If some of that does come true, where you see issues around software, for example, what do the consequences look like for the industry?
Well, what's going to happen in software is going to be a very mixed bag. There will be many software companies that do extremely well with applying AI tools, and you could say even the majority will do quite well. The problem is that in lending, the majority isn't good enough. You need the vast majority to do fine, because all of your upside is getting the yield on your loan. And if any of them go bad, of course, then you start to lose money. And that's probably what we're going to see, is that over time, there are going to be winners, great winners, and there are going to be losers. And those losers, unfortunately, will have very low recovery values because they're simply going to be eaten away by AI. It's probably too early to say exactly which ones those are going to be and how big it's going to be. But in an industry that has 20, 30, sometimes even more % of their loans in software, you have to imagine that some significant part of that is going to get into trouble, and there will be losses in that space. How long it takes and just how bad it is going to be seen. And unfortunately, you've got a lot of investors who'd rather not wait around to see how bad it gets.
Is there any concern that this could morph into a structural issue? Christian, Bill Dudley says, no, this won't turn into another 2008. I guess the major systemic problem is if insurance companies have too much of this stuff and it starts to go bad.
Yeah, well, we always, over all credit cycles, you always have to look for leverage on leverage. That's, leverage is okay, borrowing is okay. It's where you borrow to make loans that can be difficult. And that was the hallmark of 2006, 2007, and going into 2008, is there was that leverage on leverage, especially short-term borrowing against longer-term assets. It's night and day different today in terms of the systemic risks that we saw in 06, 07. There is borrowing, there is leverage on leverage, and that's an important area of focus. Insurance companies, some insurance companies are exposed to that to some extent, but it is nothing like what we saw with the banks and with the securitization problems that we saw in 06, 07. That said, you could still have real second-order impact here from a credit tightening, and that credit tightening will come. There will be less and less growth in direct lending. There will be less and less growth in lending below investment grade, which has been the source of credit extension over the last several years as households have been paying down debt. Corporates have been levering up, particularly below investment grade corporates, whether it's private or public corporates. And that is going to slow. It's slowing already. It's going to continue to slow, and that credit tightening is going to trickle out into the rest of the economy. Now, it doesn't necessarily mean that it moves into a very serious shock to the economy by any means, but we have to be realistic that this has been the source of credit growth in the economy over the last several years, and it will be a source of credit tightening for the next years to come.
So there's some real economic consequences of this, Christian. I also just wonder, you've talked about this idea before that it's not just an image problem, it's a fundamental problem too, again, going back to the bad underwriting. But what you're also describing is a return to normalization and a credit cycle at the very point that everybody is trying to sell to retail investors. What happens if there's an erosion of trust?
Sure. Well, what happens if you play this forward is that the default rate may not be that bad and the returns may not be that bad, but there will not be growth in the stock of investment in this space. That is slowing fast, and it may even be negative in some places. And that's just going to mean that it's going to be that much more difficult for troubled companies with maturities of their loans coming due to be able to renew those loans. And that's how this accelerates some of this normalization in default rates, and we'll keep this default rate in this kind of mid-single digits, not just last year and this year, but out into 2026 and 2027 and 2028 as well. So you're going to have this multi-year, not an extreme peak in defaults, but a multi-year process of burning through some of these weaker loans. And that will be driven, of course, because there's not going to be the net new buyer of these loans. If anything, there's going to be a retreat of capital from the space.
But actually, I was wondering about just that, Christian. I mean, aren't there opportunities here after, Boaz started offering 60 or 70 cents for some assets? We heard Robin Dumar yesterday. He was pretty excited about putting cash to work here. Said a lot of stuff looks very interesting lately. Do you see the same opportunities?
Well, a lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them. This is becoming more of a distress type of opportunity. And in those areas, you really need high teens type of returns to make them make sense. But what's interesting, I'd say, is that it has refocused the market on other opportunities, and a credit tightening somewhere will lead to a credit tightening everywhere. And what we're seeing is emerging opportunities in what's called asset-based finance. So this would be residential mortgages, this would be consumer lending, this would be aviation finance, things like that, where that's a much more resilient profile. There's been much less leverage. In fact, there's been deleveraging in those spaces for the last several years. But when the system as a whole has a credit tightening, that creates a higher cost of borrowing for the system as a whole and creates more interesting opportunities in those higher quality opportunities that are kind of babies getting thrown out with the bathwater. So that's really where we're looking for the most opportunities, rather than pivoting into distressed sectors and trying to guess which software company is going to be the survivor.
Christian, we only have a minute here, but I want to ask more about this tightening because you've also seen in public credit markets and leveraged loans that there have been wobbles there. JP Morgan, for example, pulling back on debt that they were of Qualtrics that they were going to put into the market. What sort of mix does that create? And is there any degree where that could be a saving grace for private credit if more public and liquid markets start to pull back?
Well, it's really interesting. I mean, what we're seeing is a divergence in quality and performance, fundamental performance between IG and high-yield bank loans direct lending. Most, if not all, IG software companies are going to do just fine through the AI shock. And so to the extent that this credit tightening drives spreads everywhere higher, including in investment grade, it creates that much more of an interesting opportunity in investment grade where there isn't much real risk of fundamental impairment and defaults, the way that there really is in some of the more levered spaces in direct lending.
All right, Christian, great to get some time with you. Really appreciate you giving us your intel. Christian Strack there, president at PIMCO. Coming up the next hour, Goldman's chief U.S. economist David Miracle on the interest rate outlook. It is Fed Day. Plus, we talk M&A with Lazard's Mark McMaster and Martha Gimbel from the Yale Budget Lab on the economic costs of war. Plus, my old buddy Scott Cutler from Health Equity. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. Stocks slightly lower. Not as big of a reaction as you would expect as Brent volatility is going nowhere.
Yeah, we do see Brent crude right now spiking up, or it did spike up this morning over now $109 a barrel as a strike on Iran's South Pars gas field escalates tensions.
And it's decision day at the Fed. Chair Powell may shed light on how the Iran war is reshaping the economic outlook.
Plus, PIMCO and Sixth Street join the chorus of warnings on private credit. Meanwhile, Bill Dudley says things are bad, but not 2008 bad. We have economic data, more economic data crossing the Bloomberg terminal right now. We had seen PPI come in much hotter than expected. Now we're getting factory orders that are pretty much in line. Actually, ex-transportation, you see 0.4% gain rather than the 0.3% gain that we had anticipated from our survey, but it's right in line with what we got in the previous reading. And we are getting an FOMC decision today as well. Let's break it all down with Michael McKee. He's in Washington for the Fed Decides. Mike, what do you make of, well, PPI was out of control. What do you make of what we got just now?
Factory orders, it's interesting to follow because, of course, it does represent business investment, and we've had a lot lately, with especially with the building of AI infrastructure. So the factory orders numbers come in up just a tenth, but they were down the month before. They can be very volatile. The one thing we don't know, durable goods, no change, 0%. The one thing we don't know when this report comes out is what happens with non-durable goods, and they were up basically 0.3%. So non-durable goods, which is not AI infrastructure, is the driver for today. Not enough to make a big difference. But as you mentioned, PPI terrible, coming in much hotter than expected, although the analysts who look at the parts that go into the PCE say they were not as bad as you might have feared, so they don't think it's going to have a major effect on the PCE numbers. They still, though, think they'll come in at 3 to 3.1% year over year, and that's going to keep the Fed on hold.
Yeah, I was going to say, Mike, what does all of this do for the Fed? Hotter numbers and higher oil prices.
Well, it keeps them unsure about which way the economy is going to be affected. Obviously, we'll see some headline inflation. Does there get to be some second-round effects? Do trucking companies raise their rates because fuel is more expensive? Are pharmaceuticals going to get more expensive, or plastics, things that use petroleum in their manufacture? And does this slow down the economy? The fact that the gasoline price rise has been so dramatic, do people stop spending on other things? that would call for two different kinds of Fed responses. And so they're going to be on hold today. What will be interesting to see is whether the hot PPI influences someone like Chris Waller, who's been saying we should take out insurance cuts, or whether we will see him not dissent this time because he thinks that it's worthwhile keeping rates where they are given the uncertainty about inflation.
Mike, thanks so much for joining us. That's Bloomberg's Michael McKee in Washington. And Mike will be part of the All-Star Fed coverage. Our special coverage kicks off at 1:30 p.m. New York time for the Fed Decides. Joining us now is David Miracle, Chief U.S. Economist at Goldman Sachs. David, thanks so much for joining us. How are you thinking about, maybe not today, but the path forward for the Fed if we are grappling with figures coming in hotter for PPI and elsewhere and oil prices that continue to surge?
Yeah, as you alluded to, today I don't think we'll get any policy move, but I do think we'll probably see 3 dissents in favor of a 25 basis point cut. So a bit of a signal that some people are a little bit more focused on the labor market risks. Now, we've also heard from quite a few Fed officials in recent months that they're not ready to move and envision a somewhat longer pause because inflation, as they look at it, as they interpret the official numbers, still too high for them to be comfortable cutting. A spike in oil prices in a war is going to only sharpen those divisions on the committee because it will push up inflation while also pushing down growth and creating a little bit more concern about the labor market. We recently pushed back our forecast for rate cuts to September and December. I envision by the September meeting that you'll have a bit of a dual rationale for cutting, that the unemployment rate in our forecast will be up to 4.6%, that underlying trend inflation, admittedly a bit more of a murky concept now that we have both tariffs and oil prices passing through to the core, that will look better, at least if you interpret it the way that I would, and that those forces combined might make the case for a cut. But I do imagine going forward, unless the labor market weakens a lot more, that these will be somewhat controversial decisions on the committee.
You saw the PPI number this morning. I'm not sure how the Fed takes that into account, as this is day 2 of their meeting already. But how does that feed through into your forecast for inflation? Because you have a core PCE forecast of only 2.4%.
So exactly as Michael said, the components of that seemingly hotter PPI that are relevant for the PCE consumer price index actually looked a little softer. So not by a lot, but by a tiny bit. We actually brought our forecast down a touch for this month. Broadly, I would say it's right that January and February we had firmer prints on inflation. Now, my interpretation of that would be that a lot of it is probably the last of the tariff pass-through. The start of the year is when companies do a lot of their annual price resets. If you had not passed through all of the tariff costs that you were ultimately planning to pass through, that would be a pretty natural moment to do it, and I suspect some of that happened. But at this point, most of the tariffs are old news. The largest tariff was done almost a year ago in April last year, so I suspect at this point, and our analysis would suggest this, that we're through most of it, that going forward, the underlying trend will be lower. The new thing we have to grapple with, of course, is that now higher oil prices will pass through to airfares, to other transportation services. The effects of this on the core will not be enormous, but we think probably do add another couple of tenths. And we're in a range where a tenth up, a tenth down, people might have different perspectives on the FOMC.
Jeff Curry was talking on Bloomberg Surveillance this morning at Carlyle, and formerly at your shop. He was saying we haven't yet priced in the effects of higher fertilizer prices on foodstuffs, higher plastics prices on the end products that goes into, which is everything, right? It seems like there's a lot more here than just oil. Could be tip of the iceberg.
I think it depends on how long this lasts, whether you wind up getting those sorts of shortages. I mean, certainly we did learn during the pandemic that shortage effects on inflation can be very extreme. If this doesn't last more than, say, another month or so, then I would think the impact on prices primarily is the impact that comes through oil. If it lasts a lot longer, then I think we would start to take some of those other risks more seriously.
So 2 months of this you think is no big deal? for inflation?
I think it's difficult to say. I would say the U.S. is less exposed than a lot of countries to those Middle Eastern trade choke points. So this is going to be very country by country, and the same is true of the energy price pass-through. That has a bigger impact on inflation and inflation psychology in some countries than others. But for now, I would say the impact, I think, probably is the impact we get via oil prices. And that's not huge, at least on the core, but will be noticeable.
Because we don't yet know the duration of how long this conflict will last, there are those question marks. And Claudia Sahm pointed out that in 2020, the Fed suspended their SEP because they didn't know where this economy was going because of the pandemic, and said that the Fed should do that again. Are there too many unknowns right now for the Fed to be able to give their summary of economic projections?
2020 was pretty extraordinary, so I think it was understandable that they didn't want to make forecasts when the pandemic was beginning and people were suddenly locking down at home. We've seen many large fluctuations in oil prices under more mundane circumstances over the last 25, 30 years, not the sort that we saw in 2022 when many other forces were also driving up inflation. So I think that the Fed will actually, and the Fed staff will have quite a good handle on how to project the impact of a isolated increase in oil prices on growth and inflation.
Is this Chair Powell's penultimate meeting with the Fed? Is this the second to last time that Jerome Powell sits on the board?
That would be my assumption, yes.
Yeah. So you think we get Congress and the Senate, most importantly, to go ahead and confirm Warsh?
It sounds like the Trump administration needs to move past the investigation for Warsh to get confirmed. But once that happens, I would assume that he will. And I don't know for sure, but I would assume that, yes, by the time of the June meeting, we have a new chair.
No one knows, but it seems like the interesting question today. I'm sure he won't say anything about it in the conference, but I wonder if he stays on the board. He has the right to do that, right? Or if...
That's right. He could stay as a governor. Most chairs, when their term as chair has expired, have wound up leaving. At least in recent history, that has been the pattern. There is one historical exception, but the norm is to go.
Can't blame the guy for wanting a break and not to be, truthed at.
I would definitely
from the president's
retire.
office.
Yeah, no, I would be done. Absolutely done.
David, thanks so much for joining us. We always appreciate it. David Miracle of Goldman Sachs. A quick check on your equity markets about 40 minutes into your trading day, and it continues to be the headlines in Iran that dictate market movements. The S&P still down about 0.25%. The Nasdaq down 0.1. 10-year yields go higher by 2 basis points. 421.99 is where we stand. Two things impacting it. One, Iran publishing a list of Gulf energy sites that it says it might attack. Also, Israeli attacks and U.S. attacks on Iranian oil infrastructure, and hotter PPI. So the price of oil moving up this morning by 5% is where we stand on Brent at 108.70 on the price of oil per barrel. Matt.
Let's get a look at some of the single stocks moving at this hour. Alibaba and Baidu, both of those ADRs moving higher as the companies plan to raise prices for their AI products by as much as 30%. Macy's beat expectations for fourth quarter sales and profit and issued guidance that was cautious but better than analysts had feared, and Lululemon fluctuates after forecasting a second straight year of profit declines, adding urgency to the company's search for a new CEO who can make pants that aren't see-through.
Chip Wilson wants to say on this, and he famously also had his snafu about see-through pants.
He had his say. I remember that.
He definitely had his say. Coming up on this show, Mark McMaster, Global Head of M&A at Lazard, on his outlook for global deal-making amid geopolitical tensions. You are watching Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. Iran warns Gulf energy sites are now legitimate targets after Israel struck at South Pars gas field, escalating regional tensions. Oil surged up over $109 a barrel, still up there as energy facilities in Qatar, Saudi Arabia, and the UAE face rising missile threats and escalating tensions. President Trump is suspending the Jones Act for 60 days. That lets foreign-built ships move oil and gas between U.S. ports to cut transport costs during the Iran war. The White House says the move could ease supply strains and shave about 10 cents off of gas prices. Analysts caution that the impact may be limited amid what the International Energy Agency calls the largest oil supply disruption in history. And U.S. Trade Representative Jamieson Greer said trade talks with Canada have fallen behind talks with Mexico as the administration prepares for this year's review of the U.S.-Mexico-Canada agreement trade deal. The pact runs through 2036. It allows any country to exit with 6 months' notice, though. And President Trump, who negotiated the deal initially, has now floated the idea of pulling out of the deal, keeping pressure on negotiations. Danny?
Let's turn now to M&A, and deal makers are proceeding with caution as the war in Iran risks denting momentum in an M&A market that was already showing some signs of slowing. I spoke with Paul Taubman of PJT Partners on his outlook for the rest of the year.
It was not that long ago that we were looking at a market meltdown approximately a year ago with the whole tariff issues and the uncertainties and the like. At the beginning of this year, Greenland surfaced as an issue. So when we think about all of the geopolitical hotspots, the idea that we're going to go through an entire year unscathed, I just don't think is realistic.
Joining us now is Mark McMaster, Global Head of M&A at Lazard. Mark, thank you so much for joining.
Thank you for having me.
And Paul there was talking about this idea of deja vu, that we keep entering the year really bullish, and then volatility crops up, and it starts to stymie things. I know you and the team had pointed out in your year-ahead research that last year, M&A volume rose 40% in 2025. Can we repeat that in 2026 when you have worries about war, software, everything else out there?
Sure. Well, it's the long-term, short-term question, right? So last year, there are some similarities because I think all the practitioners started the year pretty optimistic. And then in the second quarter, we had 2 months of tariff uncertainty. But we ended the year with over $5 trillion of M&A, which was the second best year on record. It was up 40% globally. And I would say there were a number of trends that we saw last year that will carry, we think are long-term durable trends that will carry forward. So the first is the strategic ambition of large corporates. So deals over $10 billion, those were up 120%. They were fully 30% of the M&A market. And we think that's a trend that's going to continue. The second trend is the simplification of middle-sized companies' portfolios. So how do they get rid of the stuff that isn't growing, and how do they align their portfolios with long-term secular growth trends? So that's, and then the final trend that we saw, and that was up 50% last year. And the final trend is just take privates of smaller companies that don't have scale or don't have enough scale to compete or are otherwise unstable. So we think all three of those trends will continue. So when I look to this year, M&A is actually up 10% overall this year. North America is up 10, Europe's up 50, the rest of the world's up 100 probably, and Asia Pacific's down a third. But when I look at two of those three trends, the large deals, those are up over last year through the middle of the month, both in terms of number of deals and the aggregate market value, and the same thing with the take private. So what we have is a lot of uncertainty around the Iran conflict, and I think the key question is, for how long will it last? What's the duration? And so that's what everyone's watching is how long will it last?
So if it's only a few more weeks or another month, let's say, David Miracle was saying that he doesn't think it's going to have a meaningful impact on U.S. inflation. Would you say the same is true for M&A if it's just another few weeks or another month? You know, the conflict in total lasts 7 to 8 weeks. That's okay for M&A?
I think that's right. People are watching, oil price impact on inflation. They're watching the supply chain for non-energy impact on inflation. But if it's just another couple of weeks, the long-term strategic conversations are ongoing. So I think this will affect when deals are announced, but not whether or not deals get done.
We have, though, seen, one of the longer-term trends is this unknown anxiety over AI. There have been IPOs that have been pulled because of concerns about how software-related stocks might behave in the market. What are you seeing in deal flow when it comes to the tech sector?
So last year was an incredible year for software M&A. And then early this year, late last year, AI put into question what's the terminal value of a lot of these software investments. We saw the public markets really almost indiscriminately take software down. Just broad brush. I think the private markets are a little bit more discerning. It's almost company by company, so they're really looking carefully. But as it relates to M&A, the public company bids are much lower than they were, and the private equity bids are lower still. So this is going to take a while to sort out because it is a complicated question about what's the terminal value of these businesses. And then you add leverage to the equation. So leverage in choppy markets, leverage amplifies returns both up and down. So I think software is going to take a little bit to sort through, and I think it will have significant impacts on that particular sector of M&A.
You know, I always look at the MAGO page on the Bloomberg terminal, and if you click on the time series tab, you can see both the value of transactions as well as the number of transactions. And I wonder if the AI disruption, changes the price of the asset, but maybe increases the number of assets that get sold because more companies will be distressed.
Yeah, and it depends on what part of AI. Right? So there's a whole bunch of activity around the infrastructure needed for AI. So like anything around the data center, cooling, all those companies, those transactions are taking place at pace. There will be more AI transactions that are AI specific. Last year there weren't an incredible amount of those. Those are ramping up quite quickly. But I think AI is going to have really positive effects in certain areas, and it will have more dilutive effects in others as you think through the individual value of companies that are
Sure,
affected.
I just mean some software companies, all of a sudden they don't have the pricing power they thought to in terms of, ARR, right? So now it's looking like a much better option to sell to a bigger competitor.
That's right. But the terminal value is in question. So the question is at what price?
For sure.
And if it's private equity, how does that price relate to what we paid for it? And how does it, what's the equity value?
Especially if they paid in 2021 and paid punchy valuations for it. One of the things, tangential to this is private credit going through this moment of questions around their software exposure, what have you. Given that this is just part of the engine of deal making and financing for deals, what does it do when these questions are being raised and maybe you have private credit players themselves pulling back a little bit? Are you seeing any of that? What is that doing to the entirety of the universe?
Well, I think there's two perspectives on private credit. One is if I had a portfolio of those loans, what are they worth? That's not how we're thinking about it, right? We're thinking about how does it finance deals, to your question. And I think in terms of financing deals, there's the traditional public market and then there's the private market. And I think clients are best served to run a dual track and look at both simultaneously. Credit is available in both markets. It's more expensive than it was. And I think people are going to really focus on the underwriting standards in a way that maybe they didn't, the year before. But I think credit for deals, and particularly investment grade, will be available, and we'll be able to get deals done.
What happens to non-investment grade then? Are you going to see a maybe not freezing, but a slight icing over of the market?
I think you're going to see a real focus on underwriting standards, and I think the good companies will get financed, and the mediocre companies will probably have more trouble getting financed than they would in
Frosty. Maybe that's a healthy thing.
But I think it's binary, and depending on the enterprise that we're talking about.
All right, Mark, thank you so much for joining us. We're just out of time.
Thank you.
Mark McMaster of Lazard, and catch Bloomberg Deals today every Wednesday at 12 p.m. New York time. Still ahead, Health Equity CEO Scott Cutler is going to join us following his company's better than expected earnings. That's coming up next here on Bloomberg Open Interest.
Let's get to check out what's going on in the markets right now. We're down 0.5% on the S&P 500 and on the NASDAQ 100 right now as oil surges. $109.50 a barrel for Brent crude after Israel attacked a major gas field in Iran, and Iran says now energy assets in Gulf countries are fair game for it as well. When we come back, Health Equity CEO Scott Cutler joins us on the healthcare affordability crisis, and after better than expected earnings from his company. That's next. This is Bloomberg. Healthcare affordability is hitting a breaking point in America, and Washington is taking notice as Congress questions rising costs. One company at the center of how Americans pay for health care just reported record growth. Health Equity is the nation's largest HSA provider, manages over $36 billion in health savings, and we're joined by the president and CEO, Scott Cutler. Scott, great to have you on the program. You just put out your earnings. You beat on every line, and you raised your forecast for full year 2027. Are more Americans just waking up to the savings here? Do they need these savings?
Healthcare affordability is a central issue for most Americans. 1 in 4 Americans cannot afford a $400 unexpected medical cost. That's a problem. If you're a CEO, healthcare costs for your employees are rising much faster than wages. And for policymakers, healthcare affordability is at the center of the debate. And so we're really coming to the market with solutions that can help address that crisis.
What sort of behavior changes have you seen, Scott? I'd also be interested to know whether you can see any more maybe short-term behavior changes if oil prices go up. I realize that's very recent and too soon to say, but over the past couple years, as affordability has continued to be a concern, how are consumers on your platform changing their behavior?
We play into the market that are health savings accounts, and for those that are not familiar with it, it's an account that has a triple tax advantage. You can contribute tax-free, it can grow tax-free, you can spend it tax-free on qualified medical expenditures to be prepared for that medical event, that unexpected medical event. Employers offer these through high deductible health plans. And so the behavior that we're seeing is that as more employees adopt these types of plans, they're better prepared for their healthcare future. More employers that drive adoption within their employee base can actually save in terms of the healthcare costs that they're paying for their employees. And so these are solutions that both require engagement and education. And what we see is more people are engaged in actually consuming healthcare transparently and are prepared for it. They effectively can set up an account to address those challenges and essentially be better prepared for their future.
You had, Scott, better revenue than expected, better operating profit than expected, better EPS than expected, and you raised, as I said, your 27 revenue outlook to higher than the highest street estimate. Why, then, is your stock down 10% year to date? What are investors getting wrong here?
Well, I think investors across the sector, if you're in healthcare, technology, financial processing, there is a larger concern around AI dystopia, the challenges on the jobs market. Since we're provide a solution to a quarter of employees in the United States, I think people are questioning what is the impact of AI on the jobs factor. And so as we think about it, we announced record sales against a macro backdrop where there was only 181,000 jobs created last year. And so I think investors, rightly or wrongly, are concerned about what is the impact of AI. As an executive navigating through these things, we're deploying AI across every aspect of our experience. We're able to deliver to our members a more real-time, seamless experience. We consume a lot of software as well. We're actually still consuming that at the same rate. And so, the software vendors that have traded down significantly as a buyer of that, we need these software tools. We need these software tools to be enabled by AI as well. And so I think we're a little bit of a dislocation in the market around the true impact of AI, but certainly the concerns around what is the future health of the job market in the United States is a central concern for a lot of investors.
Scott, that's actually really interesting. Just as you say, as a consumer of these software platforms, have you asked anything different of them? Have you thought about trying to ditch any of them and vibe code it out, as it were?
It'd be really difficult to vibe code out or prompt away core infrastructure software that enables us to deliver the experience. And so, again, I think what we're asking of our partners is provide all of the tools to enhance the productivity of that software solution. And then we also develop technology that we release to our customers. And so we're leveraging all of the models that are available to us, again, for us to be able to deliver our service at a lower cost on one side, but to be able to radically enhance the experience. And so we think about how can we automate a claim? How can we automate a response that a member might have? How can we go to the market much faster as we deploy our own technology solution, to better improve our service? And so I think these are the forces that are at play, but I do not see a world where we're going to be replacing core infrastructure that has and reliant upon data and replace those at scale.
Scott, you're in a great position to be able to evaluate Inflation, we got a hotter than expected PPI number this morning, but inflation has been a problem for Americans, especially in healthcare, for many years in a row. Does it continue? Does it get worse? Do you see any improvement? And how do you view it?
Healthcare costs have been rising much faster than every other input cost that we're associated with. I think in America, we're much more comfortable treating illness than prevention. And so we have to do something about it. All of us have a role in that. And I think one of the big trends that I think has maybe the greatest potential impact is the role that we all play in our own healthcare. Are focused on wellness and prevention, which obviously, if you have an HSA and you can spend dollars towards that, helps us be more engaged as healthcare consumers. When we're more engaged as healthcare consumers, we make better, more efficient choices. Now, we need that to be applied across the entire system. We've got great healthcare in America. It is just unaffordable for most. And so we have to be able to address this problem, but we all have a role to play in terms of regulators, policymakers, companies, and individuals. And I'm optimistic that we can actually bend the curve.
Scott, great having you on. Hope we get you back soon. Scott Cutler there, President and CEO of Health Equity. Let's get a check of what's going on in these markets. They are down now at the lows of the session, about 2/3 of 1% on the S&P 500 and the NASDAQ 100. You can see that the 10-year yield is just creeping a little bit higher here, now up 3 basis points. It had been 2 for the last hour, so we're getting up to 4.23 on the 10-year yield. There are concerns, obviously, about inflation, especially with the numbers that we got this morning, but concerns about growth now as these inflation concerns start to look a little bit sticky. And you can see Brent crude there getting up to almost $110.
Yeah, and those concerns are much more acute in Europe. German 2-year yields, for example, are up 8 basis points. Now traders have fully priced in 2-quarter-point hikes from the ECB. We're not talking about that for the Fed. We'll get a decision today where they'll probably do nothing, and maybe it's just a hold, a pause, versus any conversation of a hike.
Right. It's, and you saw what happened in 1973 and 1974 when our Fed hiked into higher oil prices. That was very bad for the economy, and inflation kept rising.
Yeah, because if inflation is that bad that you're contemplating a hike, growth is probably taking a pretty big hit at the same time.
Yeah, well, that's the argument they'll be having at the Fed, and we'll be all over it for you. At 1:30 today, our special kicks off. The Fed decides. Tom Keene comes back to TV, joins John Farrow, Lisa Abramowitz, Mike McKee, and the whole team. Let's get a look at what is going on in terms of single stock stories right now. Danny, General Mills delivering disappointing earnings, weighed down by weaker demand from consumers facing economic stress.
And fertilizer giant CF Industries was down as much as 4% in the pre-market trade after Mizuho downgraded the company to underperform. But then there are concerns about the Strait of Hormuz, so shares move higher again.
And watching shares of Micron as the company faces high expectations for its earnings report coming out after the closing bell, doing a whole lot of nothing right now. But keep your eye on the ticker, MU Equity DES.
Coming up, the best metaphor that has ever been made for this bond market. It is the Hallmark movie theory of U.S. Treasuries. We're going to speak to Martha Gimbel, Executive Director of the Yale Budget Lab, who joins us next to explain. You're watching Bloomberg Open Interest.
We're not ready to leave yet, but we'll be leaving in the near future. We'll be leaving in pretty much the very near future. But right now they've been decimated from every standpoint. And again, we've had great support from countries in the Middle East, great support, but we've had no support from, essentially, no support from NATO.
President Trump speaking yesterday as investors grow wary of resurgent inflation and the rising cost of war. Last week, Martha Gimbel of the Yale Budget Lab testified before the Senate about the nation's debt and deficit. Asked why there has been no U.S. debt crisis yet, she made this amazing analogy, saying, we are currently the boyfriend at the beginning of the Hallmark movie in the big city where the girlfriend is still going out with him, even though she knows that it's wrong. But at some point, she's going to go home to the small town and find the nice firefighter and realize that there's another option. And I'm pleased to say that Martha joins us now. Martha, can I first say, how did you come up with that? That is so good. It is my favorite metaphor of this bond market.
I think one of the things when you talk to people, and and they'll say, like, why haven't markets reacted? What is going on? Why are they being so calm? You kind of say to them, like, well, they need another option, right? They can't just stick money under their mattress. And so it's not just enough for people to think, the US is looking shakier. They have to figure out a better option. And frankly, that sounds like the beginning of a lot of rom-coms we've seen, right? Where, you have Reese Witherspoon going out with Patrick Dempsey, and she has to go back home to Alabama and figure out an alternative.
She's got some Wall Street guy.
Such a good
She
movie.
really needs a hometown buddy. Hey, Martha, I wonder if you've thought about the incredible rise in the price of gold and how that relates to Russia's initial invasion of Ukraine, because it seems to me that was a huge driver of people looking for alternatives to the greenback and coming up with the gold medal.
I mean, it's hard with gold, right? Because some of that may be people looking for alternatives. But you're also just seeing more speculative movement in markets, right? You've seen this with Bitcoin in recent years as well. And so I think one thing that's really hard for people to pull out is, thinking about safe havens versus speculation. I should say, right, in response to the war in Iran, you have seen a movement back into the dollar in various ways and away from gold, which does suggest that, the safe haven status of the US dollar is not gone. It's just been weakened.
You have seen a move up in bond yields, not monumental, not as bad as Europe. We're out over the past 10 days, up some 14 basis points for the 10-year yield. If we spent over $11 billion in the first 6 days of the war, Martha, how are you looking at the deficit and the impact that this war will have?
Part of the problem is it's really hard to tell. If you look at the Iraq War, which is obviously different in many ways, they started off by appropriating about $50 billion for that. It ended up around $800 billion, and that doesn't account for various follow-on costs. I think it's really important. I think sometimes when we talk about debt and deficits, we focus on, are we going to have a fiscal crisis or not have a fiscal crisis? Debt and deficits have costs for American citizens, even without a fiscal crisis. New research from the Budget Lab shows that because of the fiscal actions that Congress has taken since 2015, if you're taking out a new mortgage this year, on average, it's going to be $2,500 a year more that you're paying than if they had acted a little bit more responsibly. And so, yes, we can talk about fiscal crises, but I think it's also important to remember that each of these actions individually is adding up to increased costs for American families.
And has erased pretty much the benefits of buying $200 billion of mortgage-backed securities. I wonder what you think is going to be the ultimate bill for one big, beautiful bill. Are we going to see bigger deficits this year? Are we going to see more debt at the end of President Trump's second term than we saw at the beginning of it?
It's very clear we're going to see more debt. I think one thing that's particularly interesting about the One Big Beautiful Bill Act is that, CBO scored it and took into account the effects on the economy. And unusually for a tax bill, it actually cost more when looking at its impacts on economic growth. We found the same thing at the Budget Lab. And that's because given where we are as a country right now, driving up deficits like this raises interest costs, which then flows through to our massive interest burden and then slows down the economy in the long run. And so I think policymakers need to keep in mind that this isn't 2012 anymore, and deficit spending looks different, and the economic impacts of deficit spending look different.
Martha, it's also those questions that have started, or at least at the beginning of the year, really led people to believe that you would get fiscal dominance, that central banks would have to start cutting in order to alleviate some of the interest costs. If we are seeing higher energy prices, there's concerns that inflation is going to be elevated, and you can't have central banks, you can't have the Fed cutting as soon or as much as had been expected. How does that change your outlook?
I mean, I think the Fed is in a really, really tough position right now. I'm very grateful that I don't have to make interest rate decisions at the moment. You've seen some weakening in the labor market, but also inflation's been really, really sticky. And certainly one of the things that is not going to be helpful is rising energy costs. And we don't know when those will abate. And so they're in a really tough situation, and I do not envy them.
We have heard about the billions of dollars that the first week of this war costs, and we talked a little bit about how much it could cost at the end. I always want to follow the money and see who benefits, you know, especially if we end up getting the Trump administration's proposal of another $500 billion in military spending. Who is the ultimate beneficiary of this, Martha? Where's that money going?
I mean, it goes to troop salaries. It goes to spending on munitions. You know, I think it's important to keep in mind that, you know, any government spending, you do have beneficiaries. It's not like the money just disappears into thin air. And that's what makes a lot of these problems so intractable. You know, one person's wasteful spending is another person's profit. And it's hard.
Martha, so wonderful to have you on the show this morning. Thanks for joining us. That's Martha Gimbel of the Budget Lab at Yale. Coming up, PIMCO says private credit tightening may start trickling into the rest of the economy and says the loans up for sales right now, they're looking pretty bad. We're going to listen to those concerns and talk about it next. This is Bloomberg Open Interest.
Slowing already. It's going to continue to slow, and that credit tightening is going to trickle out into the rest of the economy. Now, it doesn't necessarily mean that it moves into a very serious shock to the economy by any means, but we have to be realistic that this has been the source of credit growth in the economy over the last several years, and it will be a source of credit tightening for the next years to come.
PIMCO's Christian Strack speaking with Matt and myself in the last hour, saying that the deals or the loans that are coming to market, that they're not looking great. For more on this, we're joined by Bloomberg senior reporter Silas Brown. Silas, it's like every day there is someone coming up and saying there are issues we should be concerned about. We've heard from Sixth Street, we've heard from PIMCO. Where do we stand on things at the moment?
Yeah, I think we're entering the phase in BDC world of kind of it's not me, it's them kind of phase, where I feel like a lot of the bigger managers are coming out and acknowledging the real risks that are facing BDCs, but also private credit more broadly, about concentration risk, etc. But by kind of, I guess, discreet, sort of quietly pointing out that they're better prepared for the storm than others, and so I think yeah, and I think this probably will happen for the weeks and months ahead.
I feel like, you know, I'm a huge fan, Silas, of reactionary alarmists, and we got a lot of that. We got a lot of them over the last month or so, but it seems like now that's abated, and it's not the end of the world. It's not systemic. It's not 2008. It's just like we had very bad underwriting for a little while, and now there's some loans out there that nobody's going to really want to buy for par.
Yeah, I mean, I think that the danger with any kind of form of leverage product is like you are taking a risk of someone has to replace you at some point, and I think as kind of liquidity dries up, or caution kind of like surrounds leverage finance and private credit as well. I think the real fear is who's with these like maturity walls coming ahead. It's like who's gonna take my place, or will I be able to raise enough money to keep my place? And I think those questions are kind of still ahead, and I think becoming more and more pertinent.
Silas, are we still seeing some real pressure for these BDCs in terms of flows and need for redemption? What difference does it make to the overall market if the more retail-oriented sources of private credit continue to come under pressure?
Well, actually, I was just at a lunch with some European direct lenders, and they were saying, oh, it's great that we're so far behind in terms of the maturation of the industry because we haven't had to kind of, we simply don't have the infrastructure to accommodate such a kind of flow of retail money. But I mean, I think, yeah, I think, it's a significant portion of the private credit industry. So if there is if the gyrations continue to get stronger, I think that does play into I guess the kind of the quality of the asset class and the ability for the asset class to compete with more traditional forms of leverage finance and kind of maintain that margin pressure that they need to maintain. I mean, I think then what I just said earlier. I mean, like when liquidity dries up, financing options become harder for these companies, and I think if the music is slowing, then it's trickier for companies to refinance. And look, this is not something that's going to be go overnight. That's for sure.
Isn't it great though that as a structured financer, as a credit reporter, you've learned so much about AI and software, Silas?
I know. I should move to Silicon Valley with the sheer knowledge that I know now.
I'm sure
they would join Ed Ludlow.
They would welcome you. They would welcome you. Bloomberg senior reporter Silas Brown talking to us about the private credit. Is crisis a strong word? It's a strong word.
It
feels strong now. It was right on last
of Christian
few weeks.
Strock, it's a cooling, not a crisis.
Yes. Let's get a check on what's going on in the markets as we come to the top of the hour here. We're looking at losses about 2/3% on the S&P 500, 0.6 on the NASDAQ 100. The 10-year yield rising up 3 basis points to 4.23. It's really all about oil, and we still see Brent crude trading. I'll pull it up for you here at $109.56 a barrel. Coming tomorrow, Joanne Feeney of Advisors Capital, Peter Oppenheimer of Goldman Sachs, and Leslie Vinjamuri of the Chicago Council on Global Affairs.